Karan Virwani, Managing Director and CEO of WeWork India, joins in right now on the show. Karan, great having you. Thanks for taking the time out. This is Neeraj here. Good morning.
Good morning, Neeraj.
How do you sum up what's happened in the first 9 months, and as the conversation around GCCs, data centers, multiple other global offices starting off, global prime ministers coming to India, and presumably other companies wanting to set up shop, how is it that the next 12 to 18 months are looking like?
Yeah. Well, firstly, I think that we've had an exceptional 9 months. If you look at the numbers, over the last year, we've done about, close to about 2,000 crores of revenue, about 1,700, 1,800 crores of revenue. The EBITDA margins of the business are the highest it's ever been. And we also had our highest quarterly, profitability last quarter. And so I think that there are few things working and continue to work. The India talent story continues to stay strong. We see that global capability centers are hiring and hiring in numbers. The Turner deal that we did is a great example of how quickly these companies are growing. They started with just 16 desks with us, and today they have about 650 seats. And the only reason Turner got reported is because we actually had permission from them to be able to talk about it. But we have multiple such deals that we've done over the last 9 months that aren't out really in the news, but are reflected in the occupancy numbers and the way that our business is growing. So I think the India story from a talent perspective and from a real estate perspective stays strong. Commercial real estate has been growing and continues to be at its peak levels. We're just, really becoming a larger and larger part of how companies think about growing their footprint in India.
Okay, and well, which is great for your company and your shareholders as well. I wonder if the pace of change in, I mean, I know the occupancy rates are higher than what maybe the growth rates, but rates might be. But is the pace of change of pricing a lot faster than, let's say, a metric like GDP growth, for example?
Well, see, I think that it's all again like it's a supply demand, kind of conversation that we're having today in India. The vacancy levels across commercial real estate are quite low. The demand is outpacing supply by a large mile, and the speed of supply coming on in terms of new developments isn't as fast as it should be. So really what's happening is while companies like us have these ready to move in spaces and are able to actually deliver space for large companies faster because of the existing capacity that we have, and then also our speed of taking new capacity, we're becoming a big partner to enterprises and businesses in India to just be able to quickly give them office space because they need it and because the hiring is been this quick. And because the occupancy levels are high and vacancy levels are low, rental prices themselves have moved up quite drastically across some of these high micro markets. And that's also reflective in the pricing that we are able to command because we're able to offer the supply very quickly to these customers. So the GDP growth, and the way that the business is growing or the segment is growing, I think are not are connected, but also because the segment is new, it's probably growing at triple the rate of whatever the GDP growth is.
Very interesting. Karan, Alex here, and good morning to you. I'm just trying to understand, and I've had conversations with a lot of commercial developers post-COVID-19 in that phase when the type of contracts that were being signed changed very dramatically, and we've moved completely to the polar opposite of that, back to normal right now, right? So it must be refreshing for you as an industry. But having said that, I'm just trying to understand whether anything has changed in the way that you structure contracts, whether a build-up has gone back to what it was pre-COVID, where you're talking about increase in rent over a period of time. What is the longevity of the contracts that you're signing right now?
So with our customers, and because enterprise has become, such a big part of the business, the adoption from larger companies has grown significantly from COVID, and also a lot more traditional businesses that are, adopting our model. You'll see that our commitment terms have gone up from what used to be maybe 12, 14 months on average. Today we're sitting at like 28 to 30 months on average. So it's significantly gone up. Companies are willing to commit a lot more and have a longer view of their business than they did during COVID. Return to office has become fully permanent. That transition has now happened, I would say, to 90% of the market, and is slowly happening. The other thing that we're seeing is, the companies want distributed workspaces. They want distributed models, and they're also willing to pay for the flexibility of having, slightly shorter contracts than what traditional leases are. But from a flex operator provider, they're actually significantly larger than what we used to get in the past.
Okay, Karan, generally when you look at a rent and somebody that earns it, you would look at it from the perspective of yields, right? And so what I'm trying to understand is, what are your best performing markets with regard to yield? Where do they stand right now? And what is your anticipation on where blended yield could go heading into maybe FY 27, 28?
Yeah, I mean, see, I think we take our raw material is, real estate that we lease from landlords. So those are under structured contracts where we have, 15% escalations, between 12 and 15% escalations every 3 years. Versus in our contracts, it's not just the rental that the company pays for, because we actually fit out the space. We also manage the facilities within the space, and we provide all of these other common spaces. Our realization per square foot is almost 3x. So when a landlord is getting, let's say, a 7-8% yield, which is what commercial real estate typically gets, you'll see that our yield per square foot is actually closer to maybe like 20 odd percent, because we have a full stack of revenue layered on top of that raw material. And that's, I think, the difference between, let's say, a flex stock today, which is all of the flex players, and a REIT stock. The REIT is growing, in a steady way and providing yields of roughly about 7 to 8%, versus flex operators can definitely be providing you growth of close to 20 to almost 30%, IRR right now from the way that the businesses are growing.
Very, very interesting. Okay, so my last question, therefore, Karan, is if you're talking about your square foot or your area that you currently have, right? And that is your capacity. You're growing incredibly quickly. So therefore, where do you foresee, have you penciled in what you anticipate you will need by the end of FY 27, or perhaps by the end of FY 28?
Yeah, so we have pretty much our supply for the next year, locked in, which is roughly about 30,000 seats, close to about 2 million square foot of growth that we're seeing on the existing base, which is roughly about 9 million square foot as we exit March of this year. So by the next year, we'll be closer to about 11 million. And we think this 2 million sort of growth is something that's sustainable. It's really driven by the kind of velocity that we've seen increase in the business over the last 12 months. Our velocity of sale has gone up nearly, 50% just in the last 12 months. So that's giving us a lot more confidence to take more capacity while keeping high occupancies in the business. And with the high occupancies, our margin profiles will continue to stay pretty strong. And that's what's driving the growth.
Exciting. Karan, thanks so much for taking the time. Pleasure speaking with you this morning, and look forward to speaking to you again soon.
Thank you so much.